Happy Friday morning, Market Chameleons. Welcome to our pre-market show and soon to appear, Dimitri Pargamonic. How you doing, Dima?
Hey, Will, how's it going?
Good. Let's start right with the disclaimer since it's up.
Yep. So good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer.
All right.
Okay. So today, I think what we'll do is I'm going to show some examples. We're going to take a look at the open interest report to see what increased, where there was an increase in open interest. I'm going to go to the options chain, and we're going to talk about more of, how do we identify edge? Like, what does edge mean? How do we identify edge? What do we think is going on here? Which side of the trade would we think is the better side of the trade? Okay, so that's the idea today, to talk more about, edge. Okay, trade option in option trades. So let's first, I'm going to share my screen. I'll start out with the pre-market report, and then we'll move on. Okay, so these are stocks trading in a pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. I got 99 stocks on the percentage gainers list, 36 on the percentage decliners list. So from that perspective, it looks like we're setting up for a more bullish bias at the open. Let's take a look at the higher market cap stocks. So I'm using this filter here, market cap, and we got 20 billion. Let's look at stocks 20 billion or higher. So I got 24 right now on the percentage gainers list, 11 on the percentage decliners list. So not a huge list, but looks like more bullish bias right now at the open. But again, we're not seeing hundreds of stocks here, so kind of a mixed bag, but a little bit more towards the bullish side. If no questions, I'm just going to kind of move on to today's example.
Yeah, move on.
Okay, so let's start out with the open interest here. So I come here, open interest analysis, and I'm going to go by option contract. And I'm going to use my presets here just to see where there was a large open interest increase yesterday. So this is, we talked about it before, is just kind of a starting point to see on a relative basis where was there, big open interest increase. And down here, I got 143 stocks. And just looking at the top of the list, I see ABCL yesterday, stock was up 3%. And on the January 17 put, so this is a longer dated option. I see that the open interest increased by 2,000. Okay, so yesterday the volume was 2,000, open interest increased by 2,000, and the total open interest is 10,300. So this added to the existing open interest. And, so, and I see there's another trade in there as well, 3,000. The open interest increased by 3,000 on this 25 call, at 3,000 traded, and this added to the open interest as well. So I'm going to take a look at this. We'll take a look at this stock, what happened. And before I do that, I kind of have to describe with what do we mean kind of by edge. So a lot of people think, well, edge just means that, and a lot of people, the way they trade, and I get this question a lot, they look at the information and they say, which direction should I go? Is the stock going up or down? Okay. That's not really edge. Maybe you have a lean for a certain, because of certain circumstances. But today, what we're going to talk about is edge is something where we think this is a fair value and you're getting something extra to take on risk. So think of it this way. When you go to a casino, right, and you want to bet on a football game, right? Well, the casino lets you bet on either team A or B. They don't care, right? You could bet on whatever team you want. so they let you pick the team that is going to win, but they have an edge, right? They have some kind of a spread built in where they get something extra for taking the risk, right? You're paying them to take that risk. So they're going to calculate the odds, and they're going to come up with, like, this is what we think the odds are, right? That this team is favored. So they're going to say by whatever points, they give you the spread. They let you choose which team you want to bet on. Okay. But you're paying them to take on that risk. When you go to a casino and you bet on the roulette table, there's a red and a green, right? You can bet. They don't care. They're not going to tell you. They're not trying to predict which outcome is going to be red or green. They're letting you try to predict that. But what they're saying is that you have to pay them for them to take on that risk, of the red. You pick red or green, but you're going to pay them, to take on that risk. So you could be right, you could be wrong, but you're paying them some fee to take on that risk. So as long as statistically, the odds are in their favor over the long term, they're making this edge. Okay, so hopefully you guys could understand, and we're going to take a look at some examples of that today. So when we're looking at first option order flow and seeing what people are doing, we're also taking a look at which side do we want to be on? Do we want to be on that side, and how much edge can we identify? Okay, so
we just had a question from Ed asking what exactly the edge is. You're going to show us on this example, correct?
Okay, right. So that's what we're going to go to. So let's say ABCL, right? Here's ABCL, and I'm going to go to here, Jan 22, right? So I'm going to click on that. We're going to go to the options chain. Okay, so here's the options chain, Jan 22. And I see here's the 2,000 contracts that traded on this Jan 17 option, right? Jan 17 put. I see there's another one, a contract traded here 3,000 times, and something here in October. So let's take it one at a time. So Jan 17.5 put, I'm going to click on this, all right? And this is the trade. At 130.36, 2,000 contracts traded at $2.30. The market is $1.35, 230, right? And I see it's a multi-leg. So there's another part of this spread. So I'm going to take one thing at a time, right? What does this mean here? So I'm gonna click on this 145, 215. So here I see that the spread is in this is 145, 215, midpoint at $1.80. So when we look at the options market, right? The options market, there's a bid and there's an offer, right? So this is what we see. The dealer's willing to buy for $1.45. They're willing to sell it for $2.15. Okay, so the fair market is somewhere in between there, right? And they don't care if you sell it to them. They don't care if you buy it from them, because they've determined, based on all the information those dealers have, that the fair market is somewhere in between. Okay, we don't know the outcome of this. We don't know if the stock's going to go up. We don't know if the stock's going to go down. We don't know if the implied volatility is going to go up. We don't know if the implied volatility is going to go down. Just like the casinos don't know which team is going to win. The Super Bowl, they don't know which team is going to. They don't know that, but they figured out this is our best. All the information we're collecting, and that's always coming in. Here's where we think the fair value is, and if somebody wants to trade with me, then they have to pay a fee, right? So here I'm looking. This is a very wide market. If based on all the current information, right? So the information could change, just like a football game. Once it starts, somebody there could be a turnover, whatever. We don't know what's coming, but based on the most current information, this is where they think the fair value is, right? And if somebody pays, if it's worth $1.80 at this moment, and somebody pays $2.15, right? They just paid you what's that, like 35 cents in edge. All right, so 30. So keep that in mind. That's a lot of that. That's for $1.80 option. That's a lot of edge there. Okay, and that, by the way, options are marked to market. If you sold this at 215 and the markets did not move and they closed that right here, at the end of the day, your broker is going to say you just made money. Okay, because it's marked to market, marked to midpoint. So they agree to it too. The whole industry agrees that's the fair value. So
don't go out and spend it though, correct? Don't go out and spend it.
But you received edge, right? You received an edge. Like, think of it this way: if a real estate, if you think that here's a house that is worth $100,000, and somebody says, "Hey, I gotta sell this immediately. I need an immediate execution. I don't have time to wait 2 or 3 months. I'll sell it to you for 80 grand." Well, you just made $20,000 in edge. Now you have to carry that position and try to sell it. Maybe it takes you 2 months or 3 months, but you made this extra edge fee. So, right, because they needed to do something immediately, right? They needed to do something. They wanted that execution. They were willing to pay you that fee instead of waiting for somebody to show up. So so let's see, what is the other part of this trade. So here I'm looking at, this traded at 230, and we see how wide the market is. It's almost like $1, almost 50 cents an edge. Then I'm going to go over here, and I think this is the other part of it, probably. I'm just going to look. So this traded at $130.36, right? $130.36. So I have to find the other side of that trade. I'm going to go to yesterday's trades, okay? And I'm going to find yesterday's biggest trades here by quantity. So the other side of the trade here, 130.36, there's three components to it. So another side of this trade is another 2,000. So this is the 2,000 that we talked about, traded on 230. Then he traded 2,000 contracts, 155. So that's kind of in the middle there. And then another one here, 1,000 contracts, 156. And then he hit this at 30 cents. So we'd have to calculate and see. I think that there's different times here as well. But what we're doing is we're calculating the edge and saying, okay, now I see it and maybe I would want to participate. Let's say I did want to participate on it, then you'd have to first think that he might come back and do it more. And then you'd stick out your offer on the offer, or penny below, or bid on a bid. But the point is, like, do I want to be on this trade, right? Do I think the risk is worth it? And when I see it, can I do it with edge, right? So if I agree with the broker dealers, that this is a good trade, I don't know if it'll go up or down, but this is a good trade and they're giving me edge, can I participate on that trade with edge? So you would have to then, see if he would come back. So I'm just going to show you something really quick here. What I think here happened is that I think he bought that put, and within the same month, I think he sold that 25 call. So this is what I think happened. He bought this put, in January. He bought this put on the offer, and I think that he sold this call at the same time. Here it is, actually 2 trades at 155. Okay, so so you would be doing the other side of that trade if you're with the broker dealer. And here's the other thing that I noticed, that I'm like, okay, I know there's more open interest than this 2,000. So I'm going here and I'm tracking it. I'm like, okay, here's the puts. So I see 2,000 traded, yesterday, 2,000 the day before, 2,000 here, 2,500. So is this a buildup in this position, right? So let's go September 29th. So here's September 29th, the day before. What did he do? Again, 2,000 puts trade at 245 on the offer, right? Let's see what he did on the calls. Same call. He's just building it up. Here, let's see. Here, it's very similar, right? We're seeing this pattern of behavior coming back, doing more. Selling these 155. So you went right through the bid to get this multi-leg. So that's some serious edge that this person is paying to get this immediate execution. Maybe he's just hedging a position, right? He's got a lot of long, whatever he's doing, he might be hedging a position. And you have to decide, do I want to carry that risk? But the idea is, if you think that there's no reason to believe that, that this is going to crash through 17 and a half or whatever, and you think that there's edge, right, in that trade, what this is telling you is that he may come back. You kind of already have an idea which strikes. You kind of have an idea which exchanges it's trading on, where to put out your markets to perhaps get hit on a trade that has edge, right? So you're like fishing for edge. Think of it, you're scanning the markets and you're thinking like, now I'm not saying to do this particular one, right? Maybe there's a place where you don't mind owning a put or owning a call or owning a straddle or doing a, but the idea is, can I, unless you just want to sit there and pick direction and try to be right, can I do something with a theoretical edge, right? Where the consensus in the market, right? I'm looking at the market fair values. The consensus in the market is it's worth somewhere in between here. Can I participate on the side, where I think it's the good side, and can I get extra? Can I make edge? Is that hopefully starting to click, right? So even when I scan, let's go yesterday to option block trades. So sometimes I'll go to the repeat trades.
Hey, D, we did have a question about that trade. It's coming from Jake. He was asking, this is a bearish risk reversal, correct? 1 for 1.
So it depends on, so it depends on which side.
Hey, D, you've gone underwater. You sound like a fish. You want to step back and move your mic, maybe replug it in?
Yeah, how is this?
That's good. Yep.
Better. Right.
Yep.
So it depends on, the side that the person is doing, right? If he's buying the puts, selling the calls. And I don't know what he has on the other side. He could just be hedging some of his long stock, right? And sometimes people do that just because they could be sitting on gains, but instead of selling their stock, because that triggers a capital gains tax, you might start protecting it at this point and saying, hey, I'm going to use the options for now. If we go in there just to hedge some of that off, there could be lots of reasons, not necessarily because he thinks that this behavior doesn't look to me that necessarily he thinks, wow, we're going to just drop, and I really need to buy, as many puts. Like this looks to me like that he's buying some protection, or doing something, methodically against the position. But the point is, where can unless you agree with him, you just want to go and pay up the broker dealers to be on the same side of the trade. What we're looking for, what we're scanning the markets, like why are we studying the markets? Why are we using this data, right? Why is this data? Because if you're just trying to pick direction, you don't need data, right? You don't need it. It's kind of like going to the casino. If you're just trying to looking at stock prices and picking direction, and because you think you're going to be right, you absolutely don't even need research. You don't need data. You could just sit there and do it, just like you could go to the casino and try to pick the next thing going green or red. We're using the data to try to figure out where we could position ourselves, where we agree with something, and do we get paid, right? Does somebody pay us to take on the risk? Because somebody wants to transfer the risk over to you. You don't mind carrying that risk, and you're going to get paid to carry that risk, right? Just like an insurance company gets paid to carry the risk of something happening. Does that make sense? But what is an insurance policy worth, right? Well, the insurance company runs their analytics, they run their statistical analysis, and they come up with a price they think it's worth. Just like the market is coming up with the price that they think an option is worth, right? And then you could actually have the benefit of that. Looking at the data, you have the benefit of seeing that price discovery and process, right? Because we could observe that data. So that's kind of the point I was trying to make. When you're doing your scans, when you're looking and researching things, and like, for example, like sometimes I might be looking just to buy, if I think that the market is going to fall out of bed and I need some protection, I might look for places where I could buy protection with edge. Let's take a look if we could find something like that. Like here's option trades, right? I'm going to use the repeat trade screener real quick, just because I already have it set up. I only have 10 minutes to go, but I have my scans running. So I'm going to look at repeat put trades out of the money, right? And I see here there's a bunch of, trades. Why do I look for repeat trades? Because if the trades are coming in more than once, I have a good chance of putting out my bid and getting hit, right? Because I need a good probability of getting hit on a good trade. So if somebody is coming back and doing the same trade over and over, then I and I think that there's edge, I have a better chance of getting hit. So let's just take a look at here ZLAB. And again, if I'm going under assumption, well, maybe I need to protect myself. There's the market, if the market falls out of bed, it's going to pull the other stocks with it. Here's ZLAB. It's already in a downtrend, 55 days to go. Here's the 600 puts. So 600 puts traded. This is the 90 strike, 15% away. And you could see here, this is a very wide market, right? So the theoretical value is somewhere in between. Obviously, I'm going to have to hold it because there's no easy way of getting out of it. But here I see that, this traded at 410 with a 56 implied volatility. So it's very close to that bid, right? Like it didn't hit the bid, but it did close in. It looks to me like somebody placed an offer on the book and then it was swept up. Okay. So perhaps you could do it at 410. If you put in a one lot in there, maybe you get hit. And then we could figure out, well, okay, how much edge am I getting here, right? So here, oops, the market's 380, 640. So really, midpoint's 510. So it's worth somewhere. So somebody was willing already to pay 410. So we could say at least that's fair value, right? Because there's an agreement to trade it. But the markets afterwards are saying it's worth somewhere even higher, maybe as high as 510. So somebody just gave an extra dollar, because they wanted to short that put, they wanted to sell it. They gave you an extra dollar to take on to take the other side of the risk. So you're buying it for 410. Now, the stock could go up or down. I don't know. Just like a team could, just like the casino, they're taking the other side of bets. The team A could win or team B, just like the casino is taking the other side of a bet when you bet on green or red, right? We don't know the outcome. Remember, edge is not knowing the outcome. Edge is getting paid extra because the outcome is uncertain, but you're getting paid extra to carry that risk. Now, if you guys don't understand, 99% of the people that trade do not understand it. Even the big player, it's really, from the broker dealers, you're acting like a broker dealer at that point, right? That's how you're behaving. And the mindset of that, it's hard, especially when you're trying to be right. You're trying to be right in the direction, you're trying to be right in implied volatility, but the mindset of edge takes, it takes experience, it takes a different type of thinking, because you're like, all I'm doing is carrying the risk of that somebody else wants to transfer to me, and they're paying me to do it.
Hey, D, I know we get this question a lot, but Trevor, who's new, welcome Trevor, is asking, how do you know if he is selling the calls?
So here, right, I'm just looking at, these are puts, right? I'm looking at the market here, right? 386.40, the market is somewhere in between. Here I see somebody is raising that bid, right? So 54 bid, because I see here it's 42.34. I'm gonna say that here's the volatility of the stock, right? So the volatility of the stock has been, in the mid, let's say in the 55 range. So if I'm buying a downside put around here, 55 range, that's, to me, a downside put. If you're getting it at that volatility, it's probably pretty good, especially if you think that the market might be dropping and there's going to be a pull on the stock. So I'm pulling in general in the stocks. Remember, I'm going off many different assumptions in my head as well, but I'm looking at the stocks already in a downtrend. If the market gets pulled down, this perhaps will get pulled down with it. I'm not saying this is the only analysis you want to do, but this is the beginning, right? And to me, because this trades the way it traded, that I'm looking. Remember, I'm looking to buy, right? That my first assumption is that I need to buy some downside protection, some downside puts, because I think that the market might fall out of bed. I'm just giving this as an example. I'm not saying I think that right now. I'm just saying I'm giving this an example. I need to buy some puts somewhere. Where can I buy them for edge? So I'm looking here and thinking, okay, here I see a put trade. If I participated on this put from the buy side, right? If I did that from the buy side and I bought this at 410, right? If I bought this at 410, is there edge? Well, what does the market think it's worth, right? After this trade, it thinks it's worth somewhere around $5, right? So I don't care, if he's buying or so. That's not the point here. Am I getting it with edge on the side that I want to do it? All right. I think you're thinking about it as direction. Oh, he's selling it, the stock must go up. Absolutely not. That's not how I'm thinking here. I'm thinking, am I getting edge to take the other side of the trade? So that's exactly like the opposite of what I was trying to describe.
Very good.
Right.
We did have a question, and maybe
you're thinking selling, that means it's bullish, then you missed the point. Then completely this was not helpful to you.
Well, remember, people jump in all the time, D, right? So he may have just popped in the last 30 seconds,
Yeah, but
depends when they popped in.
Yeah.
But so everyone knows, go back to the whole video.
But I hear the mindset. Yeah, the mindset. Does this mean that it's bullish? He's selling. That's not what I was getting at. From the beginning, remember, I'm looking for edge. That's like saying, hey, somebody went to the casino and bet a lot on red, right? Does that mean that red is going to come out? Absolutely not. That's not what we're talking about, right? We're talking about, did they pay you an edge to bet on, to take the other side of that bet?
Yes, you better make sure you're comfortable with the edge and the other side of the bet, and how you're going to work it into your overall portfolio.
Exactly.
Cool.
Okay.
We did have a question from Freedom Lane, who's been on the last couple of days. Maybe we'll carry it over to Monday's show. He was asking, let me go to, we've had so much on the chat. He was asking if there is unusual option activity on a low float volume stock. Can you tell if the unusual option activity is bullish or bearish by looking at the stock price action after the options trade? I guess he's asking how you would look at the unusual option activity. Maybe we can go into that on Monday.
Right. We could look at it, but just you see the problem is that changing that mindset is very hard, because even if after I go with it, you see that the questions are still coming in bullish or bearish, right? Again, I'm trying to reverse it. You're not going to be able to, if that's how you're thinking, you're not trading, right? You're trying to be right in the direction. That's not how trading is. That's not what edge is, right? and it's very hard to break that mentality, right? Because you even see the two questions we got are still, well, which direction should I go? But they didn't understand really that here.
Yeah, we're not, what D's saying is you're not
Survey.
trying to piggyback the trade, think it's a bullish or bearish trade.
Exactly.
What you're looking is there edge in the trade, and do I want to have that edge, and can I trade around it?
Be around it to carry that other side of the risk. So think of it as the Federal Reserve actually did a study and said, well, why do so many people who try to trade fail? Like 100 people will open an account and trade, but that doesn't make them a trader. Like you could enter in a trade, but it doesn't make you a trader. So why does it, why do people fail? And they did this whole study Alan Greenspan, and he said that an amateur will want to be right. They're always going to be, I want to be right in something. I want to be right in the direction. I want to be right in implied volatility. And a professional will look at the markets and say, how do I make money? Right? Where is it? How do I make money? It was a big difference. You could guys go read it. And it's been that way since they did that study. It's just continued on that path, because that mindset is, well, does it mean it's bullish or bearish? Does it mean should I get long or short the stock? That mindset is what the Federal Reserve, Alan Greenspan, they did this study with PhD. They actually went out there and really wanted to figure out what's going on, and you could go read their conclusions, but that's the problem. It's hard to break, and it's hard for people to actually think that way, because how many people walk into the casino ready to play and think about how much edge am I giving up here, on every trade? Probably zero, or they would not be betting, right? They would not, and that's how the stock market is. So it's a very different way of thinking, that you have to switch your mentality, and to switch that mentality, a very small percentage, according to the Federal Reserve, can do that.
Well, there you go.
Yep.
Awesome job, Dima. This is a must watch. Everyone should rewatch this. We have people coming in, late, so everyone watch this. Really, rather than option order flow, we should have been talking about the edge and how to identify edge, and it's a great subject. Awesome job, Dima.
All right. Thanks everyone for joining. Stay safe out there. Have a great trading day, and hope to see you guys next Monday. Yeah,
Monday. And we also have Jake's show. And Jake was on the Zoom chat, and he said you hit it out of the park today, Dimitri.
Oh, thanks, Jake. I really appreciate it.
Jake loved this
Jake
episode.
is actually getting very good at finding things, because he's been sending me stuff, and it's been great. I mean, so very good, good stuff there that, Jake is, and it's like, I think Jake is, it's kind of, you're looking at the markets, you're fishing, you're analyzing, you're looking for where's that edge, and it's, it takes time to find it and scan it and figure it out, but once you get used to it and in the habit of it, you get quicker at it.
Yeah, it is amazing. So we have Jake Monday at 10 a.m. after our pre-market show, and that subject, I think, for the first call will be on volatility. So that everyone's looking forward to that. Jake, I think we already have 300 plus people registered. So follow your emails. I'll put the link on Monday so everyone has it. Actually, I'll put it in right now so everyone has it for Monday's show. D, great job. Chameleons, thanks for coming and enjoying the show with us. Great job, D.
Yep. Thanks, everyone. Stay safe out there. Hope to see you guys Monday.
Trading.